Good morning, traders. It is Friday, June 27th. Taking a look at the markets, we have equities pushing higher today. We got some interesting price action going on. We had the Nasdaq break to new highs. If we take a look over the past two sessions here, we saw it poke to a nominal new high. A nominal new high is just a sliver, just pokes into a new high, end up having some good traction and pickup here, and we're starting to see some unwinding. Now, the Nasdaq is not the overall major barometer that I follow. The key one that I actually follow for more so market signals is the SPY, the S&P 500, and we've got some interesting price action unfolding here. So we're back up to these highs. Now, we came back, we talked about this a big dead cat bounce as the market was selling off. We talked about it this day. This was a Friday, and we talked about a huge gap down on a Monday. This is when the market was putting in a bottom. And this was an update I did afterwards showing just how everyone near the bottom was searching for inverse ETFs. As everyone panics and gets out of their positions, they start betting on falling pricing, and then the market goes the other way. Well, we talked about a dead cat bounce taking place. We have had not only a big dead cat bounce, but now we're up testing these highs. So it's kind of kicked from a dead cat bounce into a rally. And now the big question is, do we have a massive double top, or you could argue a triple top, or however you want to see this. But overall, the market loves to poke to these nominal new highs. It makes a little new high. People start to cover their shorts. They get very bullish, and then the market can go the opposite way. So we have a very similar setup unfolding as what we've seen in the past with the S&P 500. Now, on Wednesday, we saw the S&P 500 and the Nasdaq both push higher, fairly strong. Yet we saw panic selling on our indicator, on our New York Stock Exchange volume indicator. And that was because the large techs pushed the S&P 500 and the Nasdaq higher, but small caps, the REITs, the energy space, the utility stocks, we saw like a broad market sell-off. And that is, I think, institutions unloading and advisors unloading some positions of portfolios. Those are the majority of positions. And today's the opposite. Today we have the S&P 500 breaking out. I think we're going to have FOMO in the market, meaning people who are short are going to start to cover. And not only that, but they're probably also going to want to buy and get long. When the markets hit new highs, there's a group of people that will want to enter because there is no overhead resistance and the trend is up. So naturally, these highs here now are going to suck in a lot of people, get them to buy. The big question is, does this hold? We could very easily see this market squeeze higher a little bit as the world unwinds their shorts. They get long. Those who aren't long the markets are going to have FOMO, seeing that the S&P 500 and the Nasdaq are both making all-time highs. They're going to have to get long. They just can't take the pain of FOMO, of missing out on gains. So they're going to jump in. So the next week or so, the next few bars are going to be very, very powerful in terms of, is it a fake out or is it a breakout? Are we going to start another bull market, which the tune has changed for a lot of people. A lot of people have gone now very, very bullish on the markets. I'm still bearish. But overall, we're testing these highs, and the market is going to try to shake things up, I think. So the big question is, do we have a big sell-off coming in the near future, or is this trend going to continue? Now, in the grand scheme of things, even though we were expecting a dead cat bounce and for the markets to roll over, we still have to trade the trends. It doesn't matter if we're bearish. If we take a look at the trends, this is the SPY. We've seen the trend. This is after the sell-off in April here started to recover. The trend turned up, and then it goes into these oversold conditions. We just had an oversold condition just a couple sessions ago. The market telling us, hey, it's oversold within an uptrend. It should have a bounce and move higher, and that's what we've seen. So we've been long the S&P, the SPY. We've also been long, this is the QQQ, the daily chart. You can see how the strategy, if you get rid of the noise, remove your opinions, and just follow price, money flow, manage positions, you can see how we had the market put in a top, started to roll over. Our strategy said, get out. The tide has changed. The trend is down. We avoided the big collapse, which this is where a huge chunk of our value is, not having to live through this. And even though it's recovered, and the general public will naturally say, well, it just recovered, you just buy the dip. Eventually, one of these won't be the buy the dip. It will sell off and keep going down potentially for years and be devastating. And that's what I focus on avoiding. You don't want to catch that. I'd much rather avoid this volatility During this time, we were in BIL, which just we earned daily interest, monthly dividend payments, avoiding all this. And then we were to buy back into the QQQ at a 5.5% lower price. And of course, we've hit some targets on the way up. We've hit 10% target. We're going for another 15% target is the next level. So overall, this is our core focus.